There's a building in Basel, Switzerland that doesn't belong. It's a brutalist cylinder-shaped tower, 230 feet tall, rising above a quiet industrial city like a nuclear cooling tower. No logo on the outside. No sign explaining what's inside. But inside that building, a small group of unelected officials writes the rules that govern every bank on Earth. This is the headquarters of the Bank for International Settlements, the BIS. Its members aren't people. They're central banks. The Federal Reserve, the European Central Bank, the Bank of Japan. They all send their governors here for closed-door meetings every 2 months. No press, no cameras, no public record. Here's the part that should make you raise an eyebrow. The building technically sits on soil that isn't Switzerland. It has the legal status of an embassy, its own private police force. Its documents cannot be subpoenaed. No court in the world has jurisdiction over it. And its officials carry full diplomatic immunity. It's essentially a sovereign state, but its only purpose is managing global money. Inside that tower, a committee called the Basel Committee on Banking Supervision writes what I call the financial constitution of the world. These are the Basel Accords. They decide how much money a bank can lend, how much risk it can take, and when it needs to pump the brakes. You've never voted on them. You've never heard them debated on CNN or Fox. But they affect your mortgage rate, your small business loan, and whether the economy crashes, more than almost any law passed by Congress. To understand the 2008 financial crisis, so why a loan application got rejected, you do need to look at Wall Street. You need to look at that tower in Switzerland. The story starts with a catastrophe most Americans have never heard of. In 1974, a German bank called Bankhaus Hersted collapsed, and not cleanly fell apart in the middle of a trading day. Because of time zone differences, American banks had already wired payments to Hersted that morning. But by the time the afternoon came, the German bank had shut its doors. The money was just gone. The global banking system froze. Panic spread across the Atlantic. The central bankers of the G10 nations had a wake-up call. Banking had gone global, but the rules were still local. A German bank could fail in the morning and wipe out American banks by the afternoon, and nobody had a plan for that. So they formed a committee, the Basel Committee on Banking Supervision. Their mission: create a universal set of standards to make sure banks had enough of a safety net to survive a crisis. For years, they argued. But in 1988, they released their first major product, Basel I. It was only 30 pages long, but it reshaped the global economy. The central idea behind Basel I was what they called the capital adequacy ratio. A simple concept. If a bank lends out $100, it needs to keep $8 of its own money in reserve to absorb potential losses. That's an 8% cushion. Sounds prudent, right? But the details changed everything. The committee introduced risk-weighted assets. The idea was that not all loans are equally risky. Lending money to the US government is safer than lending to a startup. So they created categories with different risk weights. Here is where it gets interesting and a little troubling. Government bonds were assigned a 0% risk weight, effectively risk-free. Banks didn't need to hold any capital against US treasuries or other sovereign debt. Residential mortgages got a 50% weight, half as expensive to hold as regular loans. Corporate loans, money lent to actual businesses, got a 100% weight, the most expensive. On the surface, this sounds logical, but think about what this math actually incentivizes. If you're a bank CEO looking to maximize profit while meeting your capital requirements, what do? You shift toward government bonds because they're free. You push heavily into mortgages because they're half the cost. And you pull back from business loans, the very lending that drives economic growth, creates jobs, and funds innovation. Basel I didn't just regulate banks. It quietly steered the entire global financial system toward government debt and real estate, and away from productive enterprise. But banks didn't stop there. They found a loophole. The rules said corporate loans required an 8% capital buffer. But if you sold the loan to someone else, you didn't need any capital at all. Just get it off your books. That insight birthed the modern securitization era. Banks figured out they could originate a loan, bundle it into a bond, sell it off their balance sheet, and start all over again. No skin in the game. No consequences if the borrower defaulted. Sound familiar? That's the original to-distribute model that turned American mortgages into toxic securities and blew up the global financial system in 2008. The seeds were planted not by reckless bankers alone, but by the Basel Rulebook itself. By the late 1990s, everyone knew Basel I was too crude, so the committee went back to work. After years of deliberation in those wood-paneled conference rooms, they released Basel II in 2004. If Basel I was a pamphlet, Basel II was a phone book. The core upgrade was scientific risk weighting, instead of lumping all corporate loans together. They had rely on credit ratings from agencies like Moody's and S&P. If a company was rated AAA, banks needed less capital. If it was rated B, they needed more. In one stroke, the committee outsourced the safety of the global banking system to 3 private rating agencies in New York. We all know how that ended. But Basel II made an even bigger mistake, the internal ratings-based approach, or IRB. The big banks JP Morgan, Deutsche Bank, Goldman Sachs lobbied hard for this. Their argument, we are sophisticated, our computer models are better than your rules, trust us. And, unbelievably, the committee agreed. The world's largest banks were now allowed to use their own internal models to calculate how much risk they were carrying and therefore how much capital they needed to hold. That's like letting students grade their own exams. Predictably, the models always reached the same conclusion. We are very safe, and we do not need much capital. The banks slimmed down their capital buffers to razor-thin margins. They optimized for maximum profit, assuming their risk models were essentially perfect. Basel II was fully rolled out in Europe just in time for the 2008 crash. Here's the kicker. Many European banks were operating under Basel II rules when they loaded up on American subprime mortgage bonds. Why? Because Moody's and S&P had slapped them with an AA ratings. Under the Basel framework, AAA, A-rated bond had a very low risk weight. It was capital efficient. A bank could hold billions in toxic mortgage securities and tell regulators, look, according to the Basel rules, we are perfectly capitalized. The rules did not prevent the crisis. They validated it. They gave a scientific stamp of approval to a massive gamble. By the time reality broke through, the damage was done. After the 2008 collapse, the committee reconvened in a state of emergency. The result gradually rolled out from 2010 onward was Basel III. The new rules were dramatically stricter. Capital requirements went up sharply. Banks had to hold higher quality capital, mostly common equity, not creative financial instruments. New liquidity rules required banks to hold enough sellable assets to survive a 30-day crisis scenario without needing a bailout. New stress tests. More buffers for the biggest systemically important banks. The goal: build a fortress around the banking system so it could never collapse again. But here is the unintended consequence nobody in Washington wants to talk about. When you force banks to hold more capital, they lend less. Lending is constrained because capital is more expensive. When bank lending slows, the economy slows with it. Small businesses cannot get loans. Entrepreneurs cannot raise capital. The lifeblood of economic growth gets squeezed. The fortress was built, but inside the walls, activity stagnated. And there's still a fight happening right now over the final phase of Basel III, sometimes called Basel III Endgame, or Basel IV. The sticking point is internal models. European banks built their entire business models around them. American banks are pushing for tougher restrictions. The proposed fix is called an output floor, a rule that says, regardless of what your fancy internal model tells you, you cannot hold less than 72.5% of the capital required by the standard formula. The European banking lobby is fighting this furiously. They say it will force them to raise capital requirements by billions and further reduce lending. The debate is unresolved, and it will shape how much credit flows through the Western economy for the next decade. There are 3 fundamental flaws baked into the Basel architecture that don't get enough attention. Flaw number 1. The monoculture problem. By forcing all banks to follow the same strategies, load up on government bonds, hold cash, avoid risky business loans, Basel has essentially made every major bank identical. In biology, that's called a monoculture, and a monoculture is incredibly vulnerable to a single disease. If one stalk of corn gets sick, the whole field goes down. In finance, if all banks hold the same safe assets and those assets suddenly become unsafe, they all fail together. We saw a preview of this in 2022 and 2023 when interest rates spiked. The government bonds that banks had stockpiled, the ones considered risk-free, crashed in value. A 30-year U.S. Treasury lost nearly half its market value. And here's the unsettling part. Under Basel rules, banks can often hide those losses by classifying bonds as held to maturity. They can pretend the bond is still worth 100 cents on the dollar, even when the market says it's worth 60. The capital ratios banks report publicly, the numbers politicians point to as proof that the system is sound, are often a mirage. If banks were required to mark all their government bonds at actual market prices, many would be technically insolvent right now. The Basel Rules, designed to ensure transparency, have institutionalized the fiction. Flaw number 2. The shadow banking problem. Because Basel made it expensive for traditional banks to lend to actual businesses, that demand didn't disappear, it just migrated. It moved to the shadow system. Private credit funds, fintech lenders, alternative asset managers like Blackstone, Apollo, and KKR. These firms are not banks. They don't take in deposits. They're not subject to Basel capital rules. They don't have to hold liquidity buffers. They can take the risks that regulated banks can't touch. Today, if a mid-sized construction company or tech firm needs a serious loan, they often don't go to Wells Fargo. They go to a private credit fund. And that fund has almost no regulatory oversight. We've created a two-tier financial system. The clean, regulated tier that holds government bonds and processes payments but does very little real, risky lending, and the shadow tier that actually funds the economy but operates in the dark. Here's the dangerous question. If one of these massive private credit funds collapses, will the government really let it burn? Or have we just built a new generation of too-big-to-fail institutions, ones entirely outside the reach of Basel? Flaw number 3. The sovereign debt fantasy. The entire Basel framework rests on one foundational assumption: that government debt is risk-free. That's why sovereign bonds get a 0% risk weight. The logic is that governments can always print money to pay their debts. But printing money isn't the only risk. There's also interest rate risk. There's inflation risk. And there's the slow-building risk of governments that have borrowed too much for too long. The 2022 to 2023 Treasury bond crash was a warning shot. When inflation came roaring back and the Fed raised rates aggressively, the safe assets at the core of every bank's balance sheet cratered in value. The regulators are terrified to confront this, because if they forced banks to recognize those losses at market value, it would trigger exactly the panic they're trying to prevent, so everyone keeps pretending. The fiction continues, and meanwhile a geopolitical dimension is making this worse. After the West froze Russia's central bank reserves in 2022, many countries started asking themselves, is it safe to hold dollar-denominated assets? Can the rules change on us? China, Russia, and the BRICS nations increasingly view the Basel standards not as neutral regulation but as instruments of Western financial power. They're building their own financial architecture. The dream of a single global banking standard is quietly dying. Here's what I want you to take away from all of this. The Basel Accords were built on a well-intentioned but ultimately flawed premise: that a committee of economists in Switzerland can calculate the perfect level of risk for a bank in Ohio, or Texas, or Tokyo. That risk is a mathematical problem that can be solved with the right formula. But risk is human. It's behavioral. It's political. It's unpredictable. By forcing every bank on the planet to look the same, act the same, and hold the same assets, Basel has created a financial monoculture. It's replaced judgment with compliance. It's built a system that's incredibly robust against the last crisis and potentially very fragile when the next one hits from a new direction. A cyber attack, a sovereign debt spiral, a pandemic, or a financial innovation the committee hasn't modeled yet. The next time a politician says the banking system is strong, I want you to hear what that actually means in Basel's language. It means the banks are stuffed with government bonds. It means lending to businesses and entrepreneurs has slowed. It means the real risk hasn't been eliminated, it's been pushed into the shadow sector, where it's growing unseen, unmeasured, and unregulated. The Basel Accords didn't fix the casino. They just made sure the house and the government holds all the chips. Now here's where this gets even bigger. The Basel Rules crushed traditional bank lending, and that created a vacuum. And in finance, a vacuum always gets filled. There's one firm on Wall Street that stepped directly into that vacuum. It's now larger than most banks, more influential than the Federal Reserve in some ways, and it owns a piece of nearly every major company in the S&P 500. I'm talking about BlackRock in the next video. Going inside the Aladdin system, the artificial intelligence engine that quietly manages over $20 trillion in global assets. Is it the ultimate risk management tool, or is it a weapon of mass financial destruction hiding in plain sight? You need to see this. Smash that like button to help break the silence on this story, and subscribe so you don't miss the BlackRock investigation. I'll see you inside the machine.